Imagine a retirement strategy where you invest 100% of your portfolio in stocks, not just in your 20s, but all the way through retirement. Sounds reckless, right? Well, a new study says it's not only possible, but it might also be the smartest thing you could do. Let's break it down. Traditional investment advice recommends a mix of stocks and bonds adjusted as you age. You've heard it before. Own more stocks while you're young, shift into bonds as you approach retirement. The idea is to reduce volatility and protect your capital. Is what most target date funds are built on. The thinking is don't chase performance, chase stability. But here's the thing, those safe investments still carry market risk and bonds lose value when rates rise or inflation spikes. And that's where this new paper comes in. In their paper titled Beyond the Status Quo, a critical assessment of life cycle investment advice. Researchers Anoklova, Sederberg, and O'Doherty asked a bold question. What if everything we've been taught about safe investing is flawed? To test this, they simulated a household investing 10% of their income over 40 years. They compared traditional strategies like the classic 60-40 stock-bond mix and target date funds that reduce equity exposure with age to a globally diversified portfolio made up of 100% stocks, 33% domestic, and 67% international. And their conclusion, the all-stock portfolio outperformed across the board. 30% more wealth at retirement, higher annual retirement income, and lower risk of running out of money. Even more striking, they found that investors following the 60-40 stock-bond mix strategy would need to save nearly twice as much, and investors following target date fund strategies would need to save 61% more just to match the retirement outcomes of the 100% equity strategy. Their study concluded that a static allocation of 33% domestic and 67% international equities throughout one's life is optimal, challenging the long-held advice of shifting towards bonds with age. So, why does this work? Why would a supposedly riskier strategy lead to better outcomes? It's simple. Stocks have historically outperformed bonds over the long term. By staying 100% in equities, you maximize exposure to growth, adding global diversification, and you reduce the risk of local recessions, inflation spikes, and country-specific volatility. Their argument, the real danger isn't market volatility, it's not having enough money in retirement. But does that hold up in real-world data? Let's take a look. This chart shows returns on stocks, bonds, and cash over a 20-year period. £100,000 left in cash in 2003 has shown almost no growth after inflation. Bonds, slightly better. But £100,000 in equities has grown nearly 6 times. Now, compare that to a cautious, diversified fund like Vanguard Life Strategy 60% equity, which has returned 148.23% since inception. If you had invested £100,000, you would now have around £248,230. Solid return, but nowhere near the compounding power of 100% stocks. So why don't we just go all in? Because an all equity strategy isn't without risk. 100% equity portfolios can be highly volatile, especially during market downturns. The swings can be brutal, and human psychology is a problem. According to Dalba, the average investor earns 2 to 3% less than the S&P 500. Why? Because they buy high and sell low. So while 100% stocks look great on a spreadsheet, real-world investors often panic at exactly the wrong time, and that's where theory breaks down. There's also currency and geopolitical risk when investing internationally, especially in emerging markets. So yes, 100% stocks might win long term, but only if you can stay invested when it feels like the world is ending. If you are young, have a long time horizon and consistent income, 100% stocks might not be reckless, it might be optimal. But this isn't one size fits all. As you approach retirement, your ability to absorb losses shrinks. Personally, I believe in taking an aggressive approach to investing while you're young, because that's when you can afford to ride out the ups and downs and let your money grow. But even in retirement, it's crucial to keep a meaningful portion of your portfolio in equities. You still need growth to outpace inflation and generate income that lasts the rest of your life. That said, your exposure to stocks should reflect your psychology, not just your time horizon. I also think it's important to maintain cash reserves at any stage of life, not for growth or for flexibility, emergencies, and peace of mind. Before adopting a 100% equity strategy, ask yourself, 1. Can I emotionally handle major drawdowns? 2. Will I need to sell during a crash? 3. Do I trust long-term math enough to ride it out? You don't have to jump straight to 100%, but it's worth asking how much is safety costing you in long-term growth. So, what are your thoughts on an all-equity retirement strategy throughout the course of your life? Would you go 100% stocks through retirement or stick with a traditional mix? Let me know in the comments. If you found this helpful, drop a like, subscribe, and most importantly, comment down below. It helps get this to more people. See you in the next video.